How about Raju, Nesa?
Missed the progress date. I don't have the file with me right now. I'm outside with my iPad. File is not with me. But I've
Okay.
completed pre-scene summary. I've completed board of directors. Out of 50 risks, I've completed 42 risks. 8 more to go. And then 20 stakeholders list I've completed.
Okay.
And industry and financial analysis is also done. So I'm working on pestle and SWOT analysis right now.
What about Nesa?
I haven't actually started on the Excel file. I have done like a Word file of like whatever my understanding of the pre-scene. I
Just the
have yet to start like with the Excel file.
So in Word file, you have just written the pre-scene summary.
Like a summary and whatever I could understand, like even board of directors little bit I have written like whatever I like, analyzed from my end.
Right. So we are getting late. We have to
Yes. No.
this for everyone. I was expecting all of you to complete by today, actually. All right. So keep this week at deadline. Uh, Obviously, if you have seen our results, why we have got so much of pass first time is just because of this analysis. Because understanding in class is easy. Let's say we are discussing F3 today, financial risk. So in the session, it might sound easier, but ultimately we need to apply to our scenario. Okay, what's happening in Cewmlator? What are the risks and how we can mitigate? And are we able to write at least one paragraph on the risk and how we are mitigating that? Most of the students are having receipts just because they are not able to express, they are not able to write, or maybe they are writing but the answer is not good enough, or the answer quantity is not good enough. So we need to practice from now. The logic we are using is for every topic. Even in the sessions, if you see last week, we discussed about financing and I gave you immediately to write about it. But some of you have still not completed. That is very important. Don't delay it. If you do all of this week by week as we are going, definitely you'll be in a very good position. Okay. So before starting our F3 as planned, let's discuss a little bit about the pre-scene. I just wanted to test the knowledge of the pre-scene. Okay. So the condition with the pre-scene, as we discussed before, is you have to read it on a regular basis, because every reading will give us new understanding. We'll know about the stakeholders, we'll know about the risk, we'll know about the financing. Okay. All right. So quickly, some knowledge test question I think I'll ask rather than asking you summary like every time. It's better if one student just give one answer so others can also get chance. If nobody is giving, that person can give again. Okay. So what was our share price? The last share price, I think September 25.
More than
120 around?
No, not 120.
105 or 103?
Yeah, we can say more than 100. Because 120 is the highest that I have given the scale. And what is our beta?
0.56.
And what does it mean?
That's basically the how the stock market moves. If the volatility in the stock is basically in the market is having more than one, then it is more riskier. But if it's less than one, then the stock is not that riskier. So it's a safe stock to basically. So the beta is less, which is a good sign for the company actually.
Right. So we are less risky than the market.
Yes, less risky than the
means we are 44% less risky than the
40%.
average.
So the average for EV vehicles is higher than 1. But when I check the average, normal average for Tesla and everyone is basically more than 1. But then accumulator is actually around 0.56, which is more, it's in a better position than compared to others.
Super. So if this point comes like financial risk, raising finance, so you can definitely mention what we are doing and also compare this to the real world industry. That will make sense. So anytime when we bring in the real world company and explain that example with the real world scenario, we can get one extra mark. That's very easy to score an additional mark. Okay. Now, what was the total cost of setting up a charging station? The breakup?
$16,000.
16?
$16,000.
16, yeah, 60. And what was the highest component in that?
Connection to electric supply, 20,000.
Right. Connection electric supply is the thing. Obviously, electricity is costly, and the connection and all of this will go up as well. So, because of this, the government is reluctant. So, what we have to do here, we have to work closely with companies like Shell. The other day, I shared something on LinkedIn also, and we are discussing. Shell is having their own this charging stations. In fact, recently the one I posted, they have a gas stations like for petrol, diesel, and just across the road on the same road, they have this charging stations. Okay, and what we have promised regarding the degradation of batteries. What is our warranty? How many years? How many kilometers?
8 years, 1,60,000 kilometers. And about the degradation also, I guess more than 20%, if my memory serves me right.
You have to be exact, Nasa. You cannot say like if I am right or not.
If it is
Because
12,
we cannot make a factual mistake.
Yeah, no, I agree. No, I'm just trying to remember, like what I remember, I'm just saying.
So technically, you are correct. It's what we are doing is 20%, but in the industry it is 30%. And next one is about the charging points. Like we have an application where people are finding the charging points. This is related to the last news article. Where should you recharge your EV? So, what do you think about this? Whether it's an opportunity for us or it can be a threat for us? Like they have mentioned, firstly, you can tell like how many charging stations are there in Duxland, and how this application based or having all of them into the same platform affect us positively or negatively. How? Arsalan, Anvay, Anirudh, everyone, please.
I don't understand how will the charging station affect positively, negatively, but I know that it's basically all of them have through the app they can download, and they can basically all of the electric vehicles, they have their own app, and the way the customers, the user can actually download multiple apps and he can use for the electric charge from there. That's what was mentioned, but I didn't get the point for how it can positively and negatively impact. What kind of question would be
I'm
built
saying
in?
we see this as a threat or opportunity. It's just a fact, right?
Okay.
I guess they have also mentioned, right? Government doesn't want to invest in the charging stations in the news articles or something below.
Yeah, that was also mentioned
Yeah.
in one
That
of the
can
news
be a
articles.
threat. Yeah, I think that can be like, I mean, people might not want to buy EVs, right, for that reason. If there
Okay.
are no charging stations.
And how many charging stations we have What's the number? How many charging stations we have in Duxland? They have given it very clearly. So it looks like you guys are reading, but not getting an exact idea. Or maybe the focus is not complete. Because these are like facts you should know, isn't it? It's a very small pre-scene, and you must have read it so many times now.
I think Mr. It was around 80,000 EV charging points in Duxland.
Yes, there are almost 80,000 they have mentioned, and this is operated by 12 different companies. Why some of these facts are important? Because if tomorrow we are doing a strategic partnership with anyone, a scenario comes over, maybe not just partnership, we have seen mostly they ask the question about acquisition. So if we are acquiring this business, so we should know how many competitors they have, how it will affect us. For example, if there is only 2 to 3, maybe acquiring them can be difficult because of the anti-monopoly law, or the government might be reluctant for us to give you direct access. But now if we have 12 different companies, that means we have some companies which are smaller, some companies are big. So might not be a problem acquiring them. And also, if they are smaller, obviously the cost wise, we can get an advantage. But the disadvantage might be the availability. Then this QR code also highlights the risk of the cybersecurity. In one of the scenarios, they have asked this question as well. Somebody was just changing the QR code, and it was affecting our reputation, because technically they have changed the payment details and the money was going to somebody else. News articles are extremely important. A lot of questions were asked from this. In fact, I have seen in every pre-scene there are at least there is at least one question coming from this, related to this. So we should know all of this news articles, vlogs, especially the news articles, very carefully, and see what type of topic can we ask from this, and how we can do some research and link this to the syllabus. Our pre-scene, obviously, other areas in the industry, the theory part of E3, P3, F3. So we'll have the content ready in the exam. The main problem in the exam is time, and in less time it's very difficult to connect everything. We might know, right? For example, now if you stress, you might recall, okay, there are 80,000, but it should be on the top of the mind. If you have the fact, okay, this is the news article, where should you recharge your EV? We have got 5 points. So there can be 5 type of scenarios that can be asked from this. So we are ready with that scenario, and we are also ready what should be our response. So if we do like this for our news article, definitely we will be in a very good position. We are almost predicting what type of question can come, and obviously when we come up with our points, we'll discuss that as well. So we are also ready with our answers. So you will be in a very comfortable position in the exam. That's what we want, and that will make easier for us to score good marks. Passing obviously is easy, it's just 52%. If we do correctly. If you do silly mistakes, if you don't know about our pre-scene itself, we are factually wrong. Our analysis and eventually our recommendation will be wrong. We can give any strategy as we discuss. All of you can have different answers. CIMA has also said officially that for one question we can have hundreds of correct answers, but we cannot give a wrong fact. For example, we are in Duxland, we cannot say we are in C land, we are in B land. No. Okay. We'll just take 2-3 minutes more here. What is the replacement cost of a battery? As per the pre-scene, what is the replacement cost?
20,000 or more.
$20,000. Right. Which one is easy to recycle, whether it's ICE car or EV car?
It's ICE car.
Ice curve, yeah.
Ice car, yeah.
As ICE car is made with more of metals, whereas EVs are made with mainly the battery components like cobalt, nickel, and lithium, which gets uh, or which is very difficult to extract back.
Even the external part of the car, we are using more of a plastic in electric vehicles because we want to keep it light. So if it's light, then the mileage is good. So, and if you compare that to ice car, it has a good of iron and steel. Obviously, depends on the company, but they have mentioned that the returns are higher. And EVs, it can be difficult. Plus, they are not getting that returns.
Misbah, I read about an article on Tesla's recycling process.
Okay.
The way they explained this, it sounded like they can do the recycling with an effective manner. So, do you have any background about it? Have you come up with?
I mean, recycling is still possible. The only thing is the cost. Why we have discussed this in industry. We'll go back to that also when required. So the main problem here is not about recycling. The main problem is it profitable to recycle? For example, plastic bottles. That's the best example. If you see globally, we are struggling with this problem, isn't it? Companies are saying they're recycling it, and some videos or some documents come in about they have made some bricks, they have made some other things out of plastic. But how much plastic is getting recycled? That's in single digit, isn't it? Why companies are not doing that? Is it that the technology is not there? It's there, isn't it? I think it's very easy to recycle the plastic compared to what we are talking now. Even if you look at a company like Coca-Cola, they are doing around, I think, 6% recycling as per some data. Why they are not doing, or why other companies are not doing, is just about the cost. It's a loss. Or maybe other strategy can be we have to increase the price of the product so much so it can cover the cost of recycle. But if you do that experiment, the society is not ready to pay for it. When we take a survey, people are saying, okay, we want environmental friendly, sustainable products, everything. But when they have to pay the premium, we are not seeing that into the sales. People are going for an economic option. Obviously, we cannot blame individuals. This might come from this should come from the government, right? Does it make sense? Raju, everyone?
Yes, Misbah, got it.
Ultimately, for anything to be sustainable, it should be beneficial for us. Just for the reputation, we can't invest so much. We cannot survive.
But what if that gives you a competitive edge compared to others in the industry where nobody is looking into the recycling process? Where with the cash that we have, if we work on R&D, and maybe the assumption is that of course it can be a costly in a general way if you have to look at it. But if we find out a feasible position where it can be done in a cheaper way, it can still be a benefit, right?
I mean, definitely, if we can find a economic way, even if it is, let's say, no profit, no loss, that might also work, and it can give a competitive edge. So maybe we'll try to work on that. We'll see in the future if we can come up something, or maybe we can even partner with our competitors and see if we can create some synergy. So the cost is reduced, and when we get the initial or maybe the ultimate working plan, everyone can share. And we cannot say that we are the only one doing it. Like you only gave the example of Tesla. Even BYD is doing. So every big company is trying to work on recycling. Especially more environmental friendly regulations have been being passed in the recent years, and I think the trend will continue. Overall, the awareness of environment has gone up. In fact, if I tell you in last 1-2 years, almost at least the second variant, like second time in 6 months, means at least all the case study, one of the question has come from environment. Like previously, we have a company called Leothair. I don't know if you guys have heard of it. So we have a pre-scene where we're sending the satellites into low Earth orbit, something like what Starlink is doing now. So in that also we have a question in the exam that the local NGOs, the environmental groups, were not happy with us because when the rocket is launched, it gets a lot of pollution. So in every case study, they are asking this. Why? Because globally there is a you know move coming in or regulations coming in or society's awareness is increasing towards the environmental factor. Even if we are not doing, we cannot say that we are not doing. We have to show at least something. Okay, we are working on it. We are almost there. Just for the reputation. You're getting the point? Okay.
Yes, Misbah.
What was our profit last year compared to this? Technically, it's both last and last year because we are in 26. And we have to assume when you're writing the answer that we are into 2026. Okay. Because by the time you'll write the exam, it will be almost like 6 months. So don't assume that the retained earnings we have or the cash at bank we have, it will be same. Things will change, isn't it? Because here we have closed the book in September and you'll be writing your exam in February. So October, November, December, Jan, Feb, 5 months, at least 5 months. Or if you consider entire Feb, yeah, you can say 5 months. Okay, what was the profit last year and this year? The net profit?
So last year, Misbah, it was around 1.2 billion D dollars, and this year we've made 3.1 billion D dollars. So it's increased by around 1.9 D billion dollars. I think it's pretty much more than double from last year.
More than double.
Yeah.
It's very rare to have that level of profit. In any industry, if you see that too, which is working at this scale, at a global scale, can we see like the profit is just doubling, more than double, isn't it? Even if we say double, it should be 2.4. Now we are at $3.1 billion. So looks like that something very good happened in the last year. And apart from that, interestingly, if you look at our revenues, from 31.8 billion, it has gone to 38.2. So revenue has not doubled, obviously. But we have shown very good improvement in our
Yeah,
other
Misbah, one
areas.
thing is obviously revenue grew also, not double as you mentioned, but at the same time, our operating costs did not grow very vastly. It was very slow growth. So I mean, it was like what probably selling and admin was 1.1 billion to 1.2, and then R&D increased to 2.2 to 2.5. It's not too much of an increase in the cost, but more in revenue. So I think probably that is one of the reasons why we have a high net profit.
Right, we have control our cost.
Yeah.
And obviously, that's the reason we are getting higher margin. And we can even link it to the property, plant, and equipment. There's an increase in PPE. So this might be because we have invested into this and this has started giving us result. Maybe we have invested in certain kind of automation. Possible. Okay. What is our gearing and what is Atom's gearing? Gearing ratio. So yeah, gearing is very important because financing question is usually asked, and in finance, whether you are talking about debt or equity, you have to bring in the gearing ratio. All of you should buy hard this. This ratio is very important.
Mr. I think cumulative gearing ratios, our gearing ratio is 43%, and sorry, ours is 41%, and Atoms is 43%.
Right. So in 2024, our gearing was 42. Now it's come to 41. Or if we be precise, it was 41.9. It has come down to 41.1. Okay, so there are two formulas to calculate the gearing: debt by equity or debt by debt plus equity. Usually, the second one is mostly use. Now, if you compare with Atom, it was 41.7 and it has gone up to 42.9. So technically, for us, it has come down, and for them, it has gone up a little bit. But interestingly, both have seen changes in their property, plant, and equipment. And the funny part is, obviously, this is just a fictional company and the country. We have the top two companies of the world in one country. Whereas in the real world, we cannot see that, especially in EV. Because Atom is leading the list. What's the market share of Atom? 16.7%, right? Then we have Dilson. And what's the market share of Cewmlator?
15.4%.
15.4. So technically, if you see, just from Duxland, we have like 31, 32, 32, more than 32%. More than 32% of the market share of a global market share only coming in from one country. So definitely, we might have certain positive factors of operating from here. Maybe the government is supportive, incentives are there, we are getting tax exemption, isn't it?
Misbah,
Yeah.
I have one point to ask. Whenever we are considering the debt by equity, in that case, we will consider the total equity fund. That means including retained funds, which are already invested into the business, or only the equity capital. Here you will find that the equity capital is 5 and retained fund is 22.3, which is invested into the company. How much should be the equity
So you
fund?
should add all. So you should use this share capital 5, reserve, and retained earnings. So technically, in the formula debt by debt plus equity, debt we are considering 20 divided by 20 plus 28.7
Yes,
billion.
yes. In that case, debt by equity fund, it will be cumulator. It is a 73 and Atom is a 81.
Yeah, if you do debt by equity.
Yeah, yeah. That equity means equity fund, 27.3. And debt is 20.
I just posted on the group again. You can check. Okay, one last question. So tell me how many countries we are operating and what we are doing there. What is our operations about? How many factories we have and in how many locations? This is very important. Honestly, I think one question will come from here. I was expecting in November, but it went different. So obviously in Feb they should ask, because this kind of different countries coming to different countries, winding up from different countries, that is where the strategy of the board comes in. They can ask a lot of scenario from here. Yeah.
We have 6 factories, 2 in Duxland, and one is in Eastland, another is on Farland, and another 2 is Windland and Groverland. Windland, Groverland, these two are 2 types of cars, Tiny and Trap. And in
Okay.
Duxland, it is Twist and Scotch. And in Eastland, it is our battery manufacturing. And Farland, it is our electric motor manufacturing.
Okay, perfect. Just one added question for everyone. Why do you think we are not manufacturing the other two cars here in Duxland? Because if we are doing Twist and Scotch, we can also do our Trap and Tiny, right? What might be the reason?
Maybe the reason is that other two type cars is the maximum numbers what we sell, which might requires huge factory setup. Maybe operating from a foreign country gives us the benefit of low labor and financing and other benefits operating from the foreign country.
Sorry, what's the benefit again?
So I was saying the other two countries what we manufacture that tiny and I think the next one. Sorry, I'm not able to remember. The reason is because that's the volume wise, those two are the major portion of cars being sold. Now, operating those cars might require a big factory, lot of labors, and that could be one of the reason operating from the foreign countries giving labor benefit, labor intensive benefit, and also maybe the financing and could be other benefits.
Right. Maybe financing or
In my opinion, is that is one important point is that if all the factories, 6 factories will be located in one particular country, so one HR problem may arise. That is one important one, because if any HR problem will in one country, so whole of the system will affect. So in that respect also, that is one of the reason. Other reasons are the benefits that dislocation of different factories in different areas is possible. Second point is the distribution towards the whole world. So in that case, if we find that they have dislocated their factory from Daxland, their battery manufacturing and the electric motor, these two are very important one. In the case of battery, I think so that it may be that it is nearness to the raw material. And in the case of electric motor, that I could not follow what may be the reason. But however,
they are going closer to the customer, or maybe they are going closer to the raw materials.
In the case of lithium battery, closing to the raw material, it will be the beneficial. In the case of lithium battery, in the case of motor, I think so it is for distribution purposes towards the world, because the motor, I think in that motive maybe that not only the supply to our cars, we can supply the others cars also as a whole.
Okay. So Nil is saying because it's highly automated and it's designed for each car type. Maybe it we want to have a very big giga factories for manufacturing this car, and we want to have a lot of automation to reduce the cost, and that's the reason we cannot have it so many in one place, or even if we have it, maybe we cannot have that efficiency. It will be too much of risk.
And another point is the efficient staffs and workers. That is in one country, it may not be possible to get. It may be that in the case of engine, electric, the specialized staffs are available in that country or like that, maybe.
That's possible, but I think human resource we can acquire if we have we are giving them good incentives. I think it's possible. That's a different scenario. Anyways, good job, guys. But we need to be more precise. Okay. Next time when you're working on the pre-scene, make sure you remember the facts. So back to F3 financial strategy. In the last session, we have discussed about the dividend policy, right? What are the options we have for the dividend policy, and what can be our recommendation? And I also gave you something to write. There is a possibility a dividend question can also come up. Maybe not high probability, but it's possible, because dividend is again an important thing. The most important part to remember there is none of this can be taken in isolation. Like we have discussed, whether it's dividend, investment, or financing, all three goes hand in hand. Okay, so today we'll start with the risk factor, financial risk. I hope you guys can see the screen. So the aim of today, aim and objectives is obviously to understand what are the financial risks. Technically, it's divided into two: interest rate and currency risk. And we'll see what are the risks we are facing in our accumulator and what should be our recommendation. As we already have the pre-seen, we don't need to take a lot of generalized example. We need to understand, we can take, but ultimately we need to see what is for us and how we can mitigate. And obviously this can link to the just question what we did, in how many countries we are operating. Okay, so a little bit of starting here. Financial risk is a risk of change in financial conditions such as exchange rate, interest rate, credit rating of a customer, or a price of goods. So technically, we are not saying it's like down, it's just change in financial condition. And obviously, when we say change, it can be positive also. It's not always that change can be negative. We need to consider the situation in a positive way. However, what happens, usually the companies, they're not looking to make profit through this. We are looking to make profit, and obviously we are profit making by selling our cars, right? That's our core business. We are not waiting, okay, to make some profit out of that if exchange rate is in our favor or interest rate is in our favor, credit rating, currency convergence, whatever it is. We don't want that. In fact, companies want it to be predictable, kind of fixed if possible, so that we know what type of cash inflow and outflow is happening, rather than risking it too much. And obviously, one of the primary reason why these things can happen is because of the government intervention. There are a lot of geopolitical factors and all we'll see in the later stage, but ultimately, who is the most powerful stakeholder? At least into one country. We are a global company, but if you look for each country, the political thing, the government. So political risk is higher. Political risk is the risk faced by an overseas investor that the host country government can take adverse action after the company has invested. So for us, it can be far land, it can be east land, it can be another land, right? So these 3-4 countries can be a problem for us. For example, exchange control regulations, rationing the supply of foreign currencies with restriction residents from buying good abroad, banning the payment of dividend to foreign shareholders, such as holding companies in multinationals, who will then have the problem of block funds. So the block fund is one of the options. In fact, we can see in our own industry. So if you take the example of country like India, they are charging more than 100% of the taxes if an international company come up with their cars. That's the reason BYD is not successful in India. In fact, if you see a lot of other luxury cars, they are not, or even other cars, they are not very successful in the Indian market. And if you look in EV, BYD is very cheaper than the competitors, but still they are not doing good in India because of the higher taxes. Let's say if it is charging 20,000, and for customer in India, at least it will charge more than $40,000. But BYD has also find some loopholes. They are trying to sell to other companies. They are selling parts, batteries to other local automobile companies, and they have become a B2B players. In fact, they were B2B players before as well. But that's a very good example how the government can have different policies for the international or overseas investors, and that is nothing wrong. They want to safeguard the job, they want to safeguard the industry. Competition is good, but again, too much competition, especially if company like BYD, they are coming from a place where government has incentivized a lot, plus they have a lot of cost benefit, so that can kill the local industry. And once the local industry is not there, the competition is not there, so the same company is charging low now can increase the price. So the customer can also lose here. Import quotas to limit the quantity of goods that subsidiaries can buy from its holding company to sell it or sell in its domestic market. Then import tariffs could make imports more expensive than domestically produced goods. These are just points. Maybe it's relevant to us, or some of them maybe not. Just to understand, insist on a minimum shareholding that some equity in the country is offered to resident investors. For example, many countries in Middle East, if you want to do business, you need to have a local citizen partner. It's there in other countries also, but maybe in Middle East, in some countries, even more difficult. Company structure may be dictated by the host government, requiring, for example, all investment to be in the form of joint venture with host country companies. It should be in joint ventures. What else can be there? Discriminatory actions can be there. Super taxes imposed on foreign firms, obviously higher than the local businesses. Then exploiting assets where the host country government seizes foreign property in the national interest. I mean, it's very rare, but it has happened in some country in Africa already. The local government has taken away all the asset, but later on they regret it because they realize having foreign businesses coming in and investing money was beneficial for the country. But there was a political scenario created that okay, they are taking away the jobs and everything should be nationalized, and eventually the country struggled. A lot of issues like problems arise over the exact meaning of the terms prompt and fair, the choice of currency, and the action available to company not happy with the compensation offered. We might be doing a lot of sales, but the sales might be just going into the taxes, or a lot of our margin is just going into the taxes, direct tax, indirect tax, isn't it? I think it will be important for us as a business because we are doing business globally. We are number 3 in the world, or in fact, we can say we are the one of the top. It's very close. There is no massive difference between number 1 and number 2 also. So let's see how we can minimize this. Then we'll discuss some scenario what risk we can face for our company and how we can mitigate. Okay. So some of the basic mitigation we can do is using political ranking tables such as Euromoney magazine tables. Methods of minimizing risk is prior negotiation. You can negotiate with the government, especially if they're going with the joint venture and all. Evaluate the country's macroeconomic situation, like balance of payments, unemployment level. If the unemployment level is high, so government will be happy to welcome the company, especially if they're creating job. But if the unemployment level is very low, they don't need a lot of this. They'll focus on the other areas, maybe in specific industries. Then the income of the people per capita GDP, we can see overall GDP versus the per capita GDP, individuals, living standard, and all of this, the education, the tech penetration. Remember pestle analysis. Why we are doing that pestle analysis, political, economical, social, technological, legal, and environment, to understand this factor, macroeconomic factor. That is not relevant to any specific industry, but the overall economy. Exchange rate policy, rate of economic growth. Here we can structure the investment, like slowly we'll do the investment. Evaluating the current government's popularity, stability, and attitude to foreign investment together with the attitude of opposition parties. Many times what happen, maybe one government is in favor of foreign business coming in, another government is not. Or we can just say it's like right or left. Every country has that. So that might also help. Entering into foreign joint ventures. Looking at historical stability of the political system. For example, recently we have seen something happening in Nepal, in Bangladesh, and other countries, in Africa also. And if we see that political system is not stable currently, or maybe it has an history of not being stable. It's stable now, but maybe the government has never completed its term. Let's say it's a 5-year term or 4-year term, and every 2 years the government is changing. That means the political system is lacking. And if there is a political instability, definitely the risk multiply. Right? So here what we can do, enter into foreign joint ventures. Sorry, here it's about obtaining agreement and contact with overseas government. Then look at changing religious and cultural attitudes, how the attitude of people are changing. What is the culture there? What is considered good maybe in this culture is totally different. For as simple as public transport. For example, if you see where we have more demand for our electric cars, if we compare Europe to US market is bigger for us. Why? The primary reason is, if you see the infrastructure in the Europe, it's more about public transport. In most of the countries, they have a convenient public transport. Like some of you are already in the UK, you can relate to that. But if you compare that to in the US, in US, if you look at maybe New York City, and we have some top cities, apart from that, car is like a basic necessity. And they have a lot of space. The parking is not an issue. So the infrastructure is there. And there is a need as well. In fact, in Europe, in many places, government is working hard to reduce or make it difficult for people to own a car. Right? So that is also one of the things we need to see. That is about the culture. Changing religions can also affect, maybe not much in our industry. Here we can use local financing. Then taking advice from company's bank, if there is a representative office in overseas country, and the company's home embassy in the overseas country. So most of this, if you see, is it's a proactive thing what we can do. But I believe we are already operating in most of the places, or we are planning to go into new places. So we have to see what can be done proactive and what can be done as a response. So what's the mitigation for this? Plans for eventual ownership, part ownership by foreign countries invest. We have the explanation of joint venture. Okay. Which of this you believe, like we have seen couple of scenarios, which of this you believe can be possible for us? Or maybe which of this we are already facing, and how we can mitigate that? Hello. Am I audible? Which of these risks we are facing?
Hello.
Yeah, Mr. Raman.
In the case of battery manufacturing, the battery manufacturing is more hazardous way of production system. And that we are doing in another country, not in Daxland. So that may come a very big effect on the government, on this government. So that is one important point.
So you mean the Daxland government?
No, to the company, because it is in battery manufacturing, it is in Eastland. So Eastland government may arise the question. Because it is totally hazardous.
Okay. You are saying like we are getting rid of Eastland.
Yes,
We are bringing it from Eastland back to Daxland.
Yes,
right?
yes. Or we have to do some more negotiation with the Eastland government.
So technically we are divesting.
Yes. We have to, and Eastland the peoples may cry for the same, because it is a very obnoxious and very hazardous production system, battery manufacturing.
Right. Or it may be for the other thing. It may be not just the battery, but any country we are currently giving jobs. We have a big setup and we are just winding from there. Maybe we are bringing to Daxland, or we have got another cheaper option. This can be an exam scenario. How do you think we can manage that?
Either we can shift it to a developing country where unemployment is a very big problem, and government is not so careful about the pollution control and limelight. So in that case, we will be beneficial.
And how we can manage? We don't know this country currently, are they developed or not? What's their employment level? But
Yes, yes, yes.
assume that's the scenario. How we
Yes.
can manage that?
We have to take some social responsibilities and corporate social responsibility on that event. We have to take some many benefits to the public and to peoples along with the employment. So to satisfy the government and the peoples that we are taking proper care with the peoples. Whatever loss it is incurring due to this hazardous production system, we are just completing this one. We are taking full care with in their sustainability report also. They are given in details that the
What full
company is
care we
taking.
can take? If people are losing job, what you can do?
Losing job means if we do the manufacturing system, why they will lose? They will get the job.
No, I mean we are changing the country. Let's say from Eastland, we are going into a different country now. So how you will
Yeah.
take care of the employees in the Eastland?
So there is only one factory there. We can shift it.
Yeah, if you are shifting, what about the people? They lose job, isn't it?
Yes,
The
yes,
local
yes.
population.
Yeah,
How will
local.
manage? That's the question.
So we do not have any botheration about that. It is not the Dachshund. It is some other country. So it
But
will not
we
affect to
have the
other
volume.
factories also.
No, what I'm trying to say, Ramani and everyone, is if you're operating currently, you have already maintained good relationship. You are contributing, and suddenly you want to just get out of there. So that will be a problem with the government, and people will lose job. Government will lose taxes, isn't it?
Of course, of course, of course. In that
And how
case,
to manage that?
we have to make a new position with the government and the publics. Because
How you manage? That's the question
why
I'm
we
asking.
will shift? Yes, why now the question is coming? Why we will shift? If it is for a hazardous problem and government will create pressure that you have to shift, then only we will shift. Otherwise, not. My point was that it is a hazardous production system, so that is the risk. That risk is bearing by the another country, not the Dachshund. So we have managed, at present, we have managed the government and the publics, and we are continuing our business. So if any problem will come further, so that extra problem, whenever it will create, so we have to manage them to the people. We have to give more satisfaction benefits to them and to the government also.
Okay. Others, any answer for this?
I think maybe, Misbah, if the exit decision from country Eastland is because of the political issue, there is no point in retaining or satisfying still the government. But however, we still need to do something about the employees who are losing the job. So that's where we can look at are there any niche skills? Can we still consider some of the employees who are highly skilled? We can move them to the new country where we are moving. Or secondly, for the other employees who are not going to get any other benefits, we can definitely look at some of the redundancy policies and what benefits we can give them as part of the exit process, which does not create much of the reputational issue for the company in that country.
Right. So here we have this joint ventures planning for venture ownership. I hope you have read this and you have seen the recording. They are just explaining what is joint venture, what is local finance, the same point. Now coming to the risk, interest rate risk. What is interest rate risk? If you are taking a loan or we have already taken the loan, the interest rate is changing. Obviously, we have fixed cash outflow now. So interest rate risk is the risk of gain or loss on asset and liabilities due to change in interest rate. It will occur for any organization which has asset or liabilities on which interest is payable or receivable. So we have two options here, fixed and floating. If a company has floating rate loan, changes on interest rate alter the amount of interest payable or receivables. These directly affect cash flows and profits, and risk therefore is quite obvious. Because let's say it's 5 plus 3. 5 is fixed and sorry, the 3 is fixed and 5 is floating depending on the central bank. So tomorrow it can become after some time 4 plus 3. So the 4 plus 3 maybe is better for us, but imagine it becomes 6 plus 3. It becomes 9 from 8. So that can be a problem for us. Fixed rate on the other hand, if a company has fixed rate loan, interest rate risk still exists, even though interest rate charges themselves will not change. A fixed rate can make a company uncompetitive if its costs are higher than those with a floating rate and interest rate cost. Imagine we are tied up with 8% and suddenly the market rate has gone down. So what will happen? We lose. Maybe we are in fixed, we are getting the same cash outflow, everything is fine. But our competitor has done in the floating rate and they are getting it for cheaper. So that's the time we are losing. So even if you don't lose directly, indirectly, we can be at a disadvantage. So usually company can choose to have a mix of both. Refinancing, it is associated with interest rate risk because it looks at the risk that loans will not be refinanced or will not be refinanced at the same rates. Reason lenders are unwilling to lend or only prepared to lend at higher rates. Refinancing risk is also there. It's not like we can keep on raising debt at the same interest. The credit rating of the company option has reduced, making them a more unattractive lending. Credit rating has changed. The company may need to refinance quickly. So if you want it quick, it can be a challenge. So actually this particular chapter is introducing us with the risk. What is interest rate and currency? Then we have a separate chapter, next one, just focusing on managing interest rate, then managing currency risk. Okay, what is currency risk? Currency risk is a risk that arises from possible future movement in exchange rate. And if you see in our business, this is extremely important. I think even both are important, but this is higher because we cannot charge our customer in different parts of the world to pay in $, isn't it? So definitely we are dealing in different currency. Mostly purchase like car, if you see, it happens in a local currency, right? It is a two-way risk, just like any other risk. It can be gain or loss also. Since exchange rates can move either adversely or favorably. Currency risk affect any organization with asset or liabilities in foreign currency, regular income and expenditure in foreign currency. Like for us, we fall in this category, isn't it? No asset liabilities or transaction that are denominated in foreign currency, even if a company does not deal. Let's say in our case, this doesn't apply, but assume a company doesn't have anything international. They're just locally operating in one country. But still, if their competition is getting the benefit from outside, then they are losing on it. Then we have economic risk. Economic risk is technically going beyond one risk. Let's say political risk we have seen. So political risk is there. Maybe technological issues are there. Economy is going down. So many things are economy means like the total GDP. Overall, there are different problems in the country. Let's say they have got a natural disaster. All of this can lead to a economic risk. And obviously, sometimes economic boom can be there on the other hand, but that boom can be a problem for the companies. It's not like economic boom is there and every company will make profit. No. How companies manage economic risk? Marketing is one of the options. Especially if you're into the basic necessity, if we market, we can still grow. Diversification of suppliers and customers. Diversification production and sales. Diversification of financing from different options. So this can be good. Diversification of production and sale is important for us. How do we think we can manage the economic risk? The problem with Cewmlator is we are just focusing cars, and that too we are focusing only on EVs. How do you think we can manage? One way we are already doing is we are into different countries. So it's very rare that we'll have the economic downturn, especially downturn will affect us, right? If people don't have much, like COVID-like situation. Downturn is a problem. So we are already into different countries. But apart from that, any other thing or any other strategy we should do to manage this economic risk?
Sir,
Yeah.
sir, one another possible problem may come economically, that is the lithium battery manufacturing. As at present, lithium is using for battery manufacturing only, and we are using it in car and others. So if any other alternative use and one technically and feasibly profitable use of the lithium will come, if it will come. So therefore, it will be very difficult task to manufacture the battery, and the total EV car system will be in some problem.
So you are
It
saying
is
that lithium is difficult to get. That's what you mean.
yes.
That is an industry risk. Yeah. And what about the economic risk? How you can mitigate that?
We have to find out the alternative sources. And
Generally,
one,
how companies do, even if you
sir,
think outside the industry.
you know that one point I have noticed in the case of Cewmlator, they have told repeatedly in the pre-scene that we are about the modern techniques and adopting automation, etc., etc. They have the R&D director also, but they do not have any R&D facilities. Facilities mean one system. R&D along with the manufacturing system, that is regularly, it is a quality control basically, R&D of that manufacturing process. But the overall manufacturing, that is the new raw material source, new development, and all this one, they do not have such facilities. That is a major risk for them.
Right.
At present, they are based on some particular raw material. They are not finding any alternative raw material.
Yeah, but raw material is not an economic risk. It's an industry. How we can manage economic risk? This is for everyone. This is for every business, every industry. No points.
So, Misbah, diversification of suppliers and customers is possible to manage the risk. That's one way of it. But then, if there is a higher power of buyer and higher power of supplier from the five forces, if we have to look at, that becomes difficult. Now, in case of cumulators, I think the source of lithium is very limited. I think I see there is more power of a supplier, wherein we do not have much option or alternate suppliers who provides lithium. So in that case, diversification may not be feasible from a supplier standpoint, but for customers, yes, definitely possible if um, country A is not feasible. Like what you said, US can be a best example of the country where we can diversify our customers from a sales standpoint.
Right. Or maybe, as we discussed previously, we can come up with the different products.
Yeah.
Like car is expensive, so we can have some other options where even in economic downturn we are getting sales, or we can go into B2B, business to business.
Yes. So, but then are you mean to say that we need to look at more of hands-off theory to whether market development or product development and then apply the economic risk and how to manage them?
Yes, yes.
Okay.
We can go to new market, and more than new market, I think it can be about the new products.
Okay.
Or usually, if you see in the real world, when companies are operating so long successfully for decades, they become a conglomerate. What is conglomerate? When they are into different industries. We are not just limited to one industry.
Right.
That also we need to consider. I don't know why we have not become a conglomerate. If an open-ended question comes, let's see how to manage the economic risk. So we can give all of these options. Okay. Transaction and translation. What is transaction when actually the buying and selling is happen? Translation is mostly, on paper. It's not a very big risk. However, it can affect our key ratios. The same point is mentioned here. Although it doesn't affect the value of entity as a whole, it can affect attribution between different stakeholders. The next is value at risk. We have discussed this in P3 is the same thing. Technically, just we are not looking at the percentage. We are looking at in that percentage what is the amount involved, and based on that, it can help to take an informed decision making. So these are like certain tools to quantify the risk. Value at risk is one of them. Okay. So for us, usually the mitigation comes in. So you should have a clear answer ready how we can mitigate the currencies. Okay, we'll get the pointers from here. And also for the interest rate. Usually, I believe they'll ask more for currency risk. The probability is higher. Okay. Before we go into this risk management, we need to understand some of the key terms. Obviously, you guys must be aware of that very basic. What is exchange rate? What is spot rate? Spot rate is something which is like 2 working days. Then we have inverting exchange rate. Exchange rate also we expect in other way around, like USD to GBP, GBP to USD, or maybe have third country also. Euro is there in between. USD to Euro, Euro to GBP, like that. Spread. What is spread? Technically, the profit what the bank is looking for. In the name of transaction charges, especially they make profit. They have different source of income banks. We usually think it's just about the interest, but they charge a lot of other things. Maybe Mahesh, if you can share some of the non-famous sources of revenue this bank and credit card companies have from your experience.
Sorry, what you said? Nisba?
What are the different source of revenues, how this financial institutions make profit?
Okay, for us, basically, we there are multiple different sources. It's not just the transactional revenue. Basically, the company, the card machines that we sell. So there is a margin inside that also. Then the maximum amount of margin usually comes from the domestic, the international transactions. If person is using a card in a different place, you get an option to, you usually receive an option that 2 different currency in the local currency, the card currency, or in the international currency. If you use the local currency, then that is always has a very higher margin. So there's a very big margin what Visa and MasterCard they make on that. Then they have introduced, we started, if you use your cards on gambling, so we charged the bank for the gambling fees. If you're using the cards in like other countries which are embargoed countries, then basically we charge the bank for that. So those kind of services are there. And then if you're using the launch service, so the launch service that you get on the card, which is free, but we charge the bank for that. We don't allow a certain amount of a limit, for the card holder to be used, and that's why we charge per card. If you visit, we charge based on that. So there are multiple different revenue, and then now they have started something else which is called consultation services. So we help the banks to promote the products for the banks, and with our name on it. So we give those marketing services, we give those consultancy services, we hire an external supplier, and then we basically put a margin on that, and then we sell those services to the banks. So there are multiple different revenue streams that we make.
Right. Super.
Okay, I have a follow-up question out of curiosity. So, from credit card, we do buy some of the electronic goods on a zero interest fees. So, does the card bank get any revenue out of it? Because it's a straight flat MRP into number of EMIs that we pay without any charges or anything.
That, yeah, that's actually that one is covered by the bank. We get the money
Okay.
immediately when you swipe the card. So if you swipe the card, let's say for 1,000, we will immediately get the whatever the markup percentage is, whatever 0.02 or something based on transactional. But then the bank makes the money on the interest, what they charge you. So if
No,
they,
it's
if you
not
split
on the
that,
interest or charge. So let's say iPhone is launched and they offer or market stating that certain credit cards you get on a zero interest, zero no options. So that way customers are
that
not
is,
charged
yes.
with anything.
Yes, that's where we make. That's where basically you use the card. That is what we want. That the card holder should use the card, the Visa card, and not the Mastercard. And that is why they give this.
Okay.
Once you use the card for such a high value transaction, it gives us revenue. So based on that,
Okay.
and that is the reason. So it is on purpose, and these are strategy for marketing strategies where they want us to use those cards. Because
Okay.
otherwise, the competitor they will get into and they will start bringing up these campaigns.
Okay. Okay. Thank you.
And also, Raju, just to add on that, the company is giving the commission to the bank. As you are saying, 0%, why they are giving us the EMI, right? Equated monthly installment, because they will charge 2-3%. For example, you buy something for 1,000 or the retail price also 1,000. You're thinking, okay, I've got an installment of $100 each month, let's say. So technically, that company is giving that thing to the bank. Technically, that 5% discount they should have given you, they are giving that 5% to the bank. So bank is making money. Maybe they are not charging you, but they are charging the company. And many times purposely they won't reduce that $1,000. They'll keep it 1,000 only. Why? Because they have the data like most of the 70%, let's say 70% of the customer will buy on EMI. So for the 30%, they don't want to reduce it, so that the other 70% feel like, okay, I'm not paying anything extra. But this is how they are getting their sales done. Because if they ask people to pay the entire $1,000 at once, maybe many of them will be reluctant. But let's say if it is $10,000, maybe 1,000 they'll pay. Even that happened at a smaller level also. I was also in touch with one of the bank, and they were like, if anybody wants to pay an EMI, it's fine. They'll pay an EMI. We'll pay you upfront. So they're able to accept the risk from both the sides. Only thing is they want to have certain percentage. Therefore, whenever we are doing a cash deal, especially in B2B, business to business, the amount is big, we can ask for the discount. But one of the things Cewmlator can also do is, if we are cash rich business, so we can pay early. We can have early payments, and we can get a discount on that. Make sense? Then
Yes,
we have
Mr.
cross the same thing. Reason for forecasting exchange rates. Okay, so what we are doing here, we is trying to forecast the exchange rate. Obviously, the forecast cannot be accurate, but it can give us an idea. How we can forecast? Let's say there is a country where the interest is higher. One of the reason can be the inflation, because the interest should be always higher than the inflation. Bank cannot make losses by giving a loan, right? So we will have a separate treasury department. In fact, a lot of big companies, they have economists. Banks especially have their own economists. They forecast the exchange rate. So what is the reason for that? Foreign debtor and creditor balance. This is possible for us. Working capital depend on this. Pricing. We have to do different pricing for different places. If investment appraisal for foreign subsidiaries, we have to raise finance. So these are like primary reason. Apart from that, obviously there can be other reasons. Why exchange rate fluctuate now? What are the reasons? Speculations. Speculators enter into foreign exchange transaction with a view of making a profit from the expectation of currency's movement. So you must have heard a lot of people dealing this as they're investing in futures, forward, and all of that. Then balance of payment. Since currencies are required to finance international trade, change in trade may lead to change in exchange rate. And ultimately, the most important is the government policy. Like certain countries, if you see, like they are developing and rich country, China, Japan, but still they want to keep their currency low because it helps them into the business. The government is ultimately the most powerful to affect the exchange rate. Then capital movement between economies will also affect. And then we have certain theories. I don't think they'll ask the theory for us. The question will be very straightforward how we can mitigate. We'll come to that point. So theories here are purchasing power parity, interest rate, and international Fisher effect. So purchasing power parity is saying that there will be a law of one price. Let's say if something is sold for $100 in one country, it should be $100 in other country. Or if it is not exactly 100, it may be like 110, 120, or maybe 90. Why that 10 plus minus is coming? Maybe because of the logistics, because of the government tariffs, taxes. That's it. Apart from that, it's not possible to have different prices for the same product in different markets. Otherwise, imagine if something like this happened, there will be an arbitrage. What it is arbitrage? Buying cheap and selling it for profit. But the arbitrage, when it will go in deep, it will increase. Eventually, it will become a single price. There is a formula. They're saying the country with the higher inflation will suffer a fall, depreciation in their currency. I hope you guys are understanding the logic. Let's say there are two countries. One country is facing inflation of 3%, and other country is facing the inflation of, let's say, 8%. So obviously the currency with 8%, their currency will depreciate faster than the currency with the 3%, right? Because things are getting expensive. That means things are not getting expensive. The value of the currency is reducing fast. This currency is losing value 3% per year, and the other currency is losing value 8% per year. Right? Yes, no?
But this will bring in more investments, isn't it? Because if it's comparatively if it's expensive, then it will be cheaper for the other countries to invest there.
Yeah, I mean it can, but that's a different scenario. What we are trying to understand is why the currency fluctuates.
Okay.
How it can affect, how it can utilize, that's a different question. But inflation is related to the currency exchange rate. Theoretically. Why practically there can be some difference? Obviously because of the government intervention. Like in Middle East, what they have done? They have tied up with the US dollar. Any movement in US dollar, if you see whether it's in Dubai, it's in Saudi or other countries, they have come up with a specific percentage. I think it's 3.65 something. Am I correct?
Yeah, 3.67 for UAE.
3.67, yeah. So you see, even the inflation now, what we are seeing in US and like UAE is totally different. But still, they have tied up. So this theory will not work there. What the problem is this cost of physical moving same products from one pricing to another, taxation. Then interest rate parity theory. They are looking at the different interest rate being charged in the country. And based on that, we are predicting the future exchange rate. So here, instead of looking at the inflation, they are looking at the actual interest. Then international Fisher effect. This is also focusing on inflation. I've explained this in the recording. You can go through detail. Not very important from the exam perspective in the case study to answer. Or if you want to answer also, you can say we have certain theory models that can be used to give us an overall understanding. Obviously not exact understanding, an overall understanding for the future. Okay. What are the process of identifying risk management? Just like any other risk, first we need to identify, quantify and all. Hedging. What is hedging? Hedging in simple words is all about managing the financial risk. Hedging can involve the reduction or elimination of financial risk by passing the risk onto someone else, or we can say sharing it with someone else. So we have advantage and disadvantage for this. In simple words, hedging is just about managing the financial risk here. Okay, hedging can provide certainty of cash flow, which will assist in budgeting process. Risk will be reduced and hence management may be more inclined to undertake investment, reduction probability. Managers at a personal level, they are risk averse. Let's say if their future bonuses remuneration depend on the risk, they'll take minimum of that. What are the disadvantages or cons? Shareholders have diversified their own portfolio. So why companies doing it? Transition cost with hedging can be significant. It doesn't happen natural. There are certain natural options like internal hedging. Otherwise, it can be very expensive. What are natural and internal hedging? For example, CIMA. Irrespective of which part of the world you are writing exam from or you're booking, you have to pay in GBP, isn't it? We'll see that. Lack of expertise within the business, we need to have a separate treasury department. Company like us, we can afford and we are having. But smaller companies and medium companies, they might struggle. Complexity of accounting and tax issues associated with the use of derivatives. In order to do that, we need to have a treasury function. So what does treasury function do? In a small and medium companies, obviously the finance department is taking care, but in bigger company like us, we need to have a specific department. The treasury function exists in every business. Through a small business, it may be absorbed by accounting. Okay. What they do, managing relationship with the bank, working capital and liquidity management, cash flow issues, long-term funding management, currency management. Technically, it's all about just making sure that we have money for our operations, we have money for our projects. That's what treasury function. But if you see finance department, accounting, they have a lot of compliance, regulation, extra things. Now, how we can manage? This is important for you guys. Okay. So we have two categories: internal hedging and external hedging. Why internal hedging? Because to save the cost, to have the control. Invoice in home currency. That's what we just discussed the CIMA example. You are paying in pound irrespective where you are from. But the thing is, I don't think it's possible for our business, especially when you're into such a big industry, and that too you have customers globally. Do you think there's a opportunity for invoicing in a $D for us? Or particularly in any department you feel like this can be done? Hello? Or can we do with that with our suppliers? Maybe customers is difficult. Can we do it with our suppliers? So they should give us a bill only in $D.
Sir,
Yeah.
hello. We can do like this way. It is just think that Darksland dollar and US dollar, and here it is India. So we are selling India from Darksland dollar, and the exchange rate of US dollar and Darksland dollar two are different. In our case, the US dollar will be easy. So instead of to sell to India from Darksland dollar, we will do from our US dollar from our USA base. We have a dealership system all over the world. So therefore, from the USA dealer, we will sell it to the India. In that case, we can manage it.
Sorry, can you repeat the last bit?
So we will sell from our USA dealer.
Okay.
Instead of from the Darksland dealer, because USA dollar to India will be beneficial for us instead of Darksland dollar due to exchange rate. So in that case, we will sell to India through USA dealer only, irrespective of the matter from where the material is coming. The invoicing will be from the USA dealer.
Yeah, so that is like using more stable currency, international currency.
Yes. That will be beneficial.
That is also
also.
an option, but this is not related to invoice in home currency. This is like using an international currency or more stable currency. If you think
Yes,
like our local currency is not that strong or it keeps on fluctuating, then we have to use an international currency.
Most of the cases, the companies, those who are dealing with the world business, they are doing in one currency, either in dollar or in GBP. Irrespective of the matter, in your country, what is actually in India to sell, they will do in the US dollar or in GBP, not in rupees. The invoice.
Right. Another thing we can do is leading and lagging. Leading and lagging is asking payment early or delaying the payment, waiting for the exchange rate to be in our favor. Like expect it to fall, expect it to go up, like that. Then
that fluctuations we have to absorb. Yes.
yeah, but I don't think this will work in our case. It's very difficult. Matching, this technique involves matching asset and liabilities in the same currency. So receivable and payable in the same currency. So that means if you are losing somewhere, we can just cover it up. Then netting, this normally involves the use of foreign currency bank accounts. If a company knows it will be both receiving and paying in foreign currency, it can reduce exchange rate or exchange risk by using foreign receipt to cover the foreign payment. Or we can just reduce our transactions itself. That will also help. Then pooling. Pooling is a system of managing cash when a business has several bank accounts in the same currency. It might be able to arrange a system with its banks whereby the balance of each bank account in the same currency is swept into a central account. So instead of doing number of transactions, everything comes at once. And from there, they are planning and everything is organized. How many transaction to be done, what benefit they can have. Because zero balance on every account except the central account. Then counter trade is something like barter system. We give them something in return like service or products. This involves parties exchanging goods and service of equivalent value. So technically, in the exam, if they ask you question how we can mitigate the currency risk, so you can say we have two options, internal hedging and external hedging. Internal hedging, from this you can give 2-3 options and explain. Then you can use some options from external hedging. And ultimately you have to recommend one. Okay, external hedging, if you see the same netting sentence, but we are doing it with the larger reduce. We're not avoiding, but we are reducing it. It can be monthly basis and all. For netting to be successful, participant must agree on the number of issues such as currencies, credit periods, settlement dates, exchange rate, confidentiality. So the litigation risk is higher here. If anything goes, it will go. So we'll agree now itself on the June price. What is the price in June 2026? How much we are buying or how much we are selling that currency. It might not be exact or spot rate of today. It may be at a premium or discount, but we are agreeing into it. So what will happen? Both the parties, especially for us, if you're doing with a financial institution, will have a certain cash flow. We know like how much money is coming in. Then we don't have to worry about losing on the currency. You don't need to worry about the calculations or how it works. Just if you know a little bit theory about it, is fine. Advantage, simple and easy. Can be purchased from bank, fixed exchange rate, tailored. Disadvantage, contractual commitment. You have already agreed. There is no upside. Then we have money market hedge. The money market are market for wholesale leading and borrowing or trading in short-term financial instruments. Many companies are able to borrow and deposit funds through their banks in money market. Technically, they are just mirroring the asset and liabilities, but done at a bigger level. But wherever banks are coming in, financial institutions are coming in, they are coming for their own spread. We have a process also. You don't need to worry about the process. Advantage you can look at. Now currency futures. Futures are derivative contracts and as such can be traded on future exchanges. The contract which guarantees the price is separate from the transaction itself. So we are just fixing the price. We are not looking at how much amount it is. So technically, if you see, it's more about just having certainty for the future. But in that we have contract, we have hedging, we have currency future, different names, but ultimately is the same thing. Only thing is the advantage and disadvantage, some of them will reduce. And some advantage might be the same. For example, we'll have certainty and some disadvantage will remain same. That is, it's costly. And you need a third party for that. You cannot do it in-house. And they are mentioning ticks. Ticks are just the points. Usually you must have noticed when we write a conversion rate, we write it like 4 digits after the decimal point, like USD 0.001. So this one is like 1 tick. This is more about reading it, to understand how to read the conversions. Let's say your USD 1.7105. So this 5 means 5 tick, or 105 means 105 tick, like that. Anyways, not relevant to the exam. Basis risk. Currency options. So here the slight difference is it's an option. So option means you have the right but not the obligation. That means if things are in favor, we'll not use it. If things are not in favor, we'll use it. That means it has a very big disadvantage that you have an upside. If currency is in favor, like we can get more money, so we can not use this option. But if you think like we can lose, so we can use this. And obviously, if you're getting an upside, then we have to pay the higher premium for it. That's the disadvantage. There are high upfront premium cost. How it is set up, you don't need to worry. There is some concept like in the money and out of the money. In the money is like in our favor, out of the money is not in our favor, at the money is exactly the same. And then we have Black-Scholes model. I don't think this is also very important. Swaps. Swap is there in currency risk and interest rate risk also. So currency or cross-currency swap allows the company to swap currency it currently hold for a different currency for a fixed period. Let's say we need money in different currency, but we have it in local currency. What we can do is we can swap to that currency. And then it will come back at the end of the period. So it will solve the cash flow problem also. Plus we don't have to accept that changes in currency. Usually, obviously, swap is done at the spot rate. That's it. I don't think you need to put all 6 options also in external. Usually this question can come max to max like 50-60%. If it is 60%, you might have to write 6 points. So maybe you can write 3 internal hedging and 3 external hedging options, or maybe 2 internal, 4 external options. Okay. And which one to recommend? They will give you some idea in the reference material. Based on that, you can get an idea. You can get some. Moving on to the interest rate risk management. Now, the risk here is about the bank changing the interest rate. Some of the key terms to know here is lending and depositing rate. If you're depositing, obviously bank will not give you the same interest because they want to use that deposit money to lend someone, and from there they'll charge higher. This is how they make profit, isn't it? This is obvious. Then we have this LIBOR rate. So LIBOR is technically the wholesale rate, like we just discussed, central bank. If the bigger bank are taking from central bank, that is like a LIBOR. And on the top of that, they will have their margins. Libid is a similar thing. This can have different name in different country also, but the logic remains the same. Yield curve is how much interest when it is getting matured. Anyways, coming to the hedging again, here you need to know what options we have to mitigate that. The first thing we can do is smoothing. The company tries to maintain a certain balance between its fixed rate and floating rate. This is very basic. This we have discussed previously. We can have, let's say, half of the money in fixed interest rate, half in the floating interest rate. Or maybe half doesn't mean exact 50, but maybe a good extent into both of that. Then we can do matching. If you see, even the terms are very similar to currency, matching and netting. We can match our asset and liabilities to have a common interest rate. Then netting, bringing all together and see what is the next net exposure and try to reduce it. And to do that, we have like 4 options. Forward rate agreement, just like we did forward rate contract with currency, same thing we can do here with the interest. FRA is a forward contract on interest rate for future short-term loan or deposit. So irrespective of what's happening in the market, we can fix it. What is the characteristic of this? This is the short term. FRA on a notional 3 loan deposit starting in 5 months time is called 5 to 8. 5 to 8, like 3 months here. And then second, we have interest rate guarantees, very similar to that. Interest rate guarantees are options on FRS so that trader has the choice whether to exercise or not. Whenever the term option comes in, it can have an upside potential. They are over-the-counter instruments arranged directly with the bank and have a maximum maturity of money. So now we are in January, so we can plan our future interest payment. If you're planning to take a loan, we can go with the interest rate guarantees. It's the same thing. If there's an adverse movement, we'll exercise the option. If it is unfavorable, we'll allow the option to lapse. Whenever option comes, this is the same logic used. Then we have interest rate futures IRFs. These are similar in principle to forward rate agreement in that they give a commitment to an interest rate for a set period. Usually it's again the short term. Same thing we can use with our bonds. Okay. Exchange traded interest rate option. This option gives its buyer the right to buy or sell an interest rate future at a specific future date at a fixed exercise rate. Actually have the right to bet. So we can use again the financial institution and we can go into this kind of interest rate options. Where your option is coming, we are getting an advantage. And if you're getting an advantage, it's not free, we have to pay the premium. The only difference in advantage disadvantage you see is about the premium. The rest, all the logic remains here. We have collar and floor also. That is something if you are going beyond normal. So we can reduce our premium with the bank and say that if something extraordinary happens, we are taking the risk. So that is like will reduce our premium. Cap and floor is maximum what can happen in normal scenario, and floor is minimum what can happen. If anything is beyond that, we are taking the risk. So in some way, bank is passing on the risk on us, and we are accepting that. That is very rare, but we are accepting that to reduce the premium. Then same thing, swap will work. Let's say if we need a loan in different currency, we are in D dollar and we need in, let's say, E dollar, and we are finding it difficult with the bank, so we can raise it locally in D dollar, then we can swap for the E dollar. An interest rate swap is an agreement where by two parties agree to swap a floating stream of interest payment for a fixed stream of interest payment and vice versa. There is no exchange of principal. And it can be used for a very long term also. Let's say a year to a 30 years. However, one good thing is if you are already tied up, let's say in fix, you can always come back to floating. Or if you're in floating, you can go back to fix. Therefore, we have this LIBOR bid rate and receiving. So we can always change fixed to floating, floating to fixed. Like for example, 3 to 3. What does it mean? It's not asked in case study, but usually if you're receiving, you'll receive 3. And if you're paying, you have to pay 10. Now with this 0.1%, we'll go with the bank as a mark. But we have an opportunity to convert fixed to floating or floating to fixed. But again, the problem is if you are doing fixed to floating now, but what happened in the next year, we don't know, especially with the long-term loan. Let's say we did some calculation, we thought like, okay, the loan rate are going up. So we wanted to go with the fixed one. But what happened next year, it actually reduced. Then what you will do? You have to come back again. Plus, there is a lot of transaction cost and you have to pay all these margins to convert. That's another problem. What are the disadvantages, especially if you see interest rate may change the future and we can be locked in unfavorable rate. Rate worthiness of the bank also very interesting. Same swap we can use in internationally, we can use locally. Is the same thing. Obviously, when it goes international, the risk just goes up. Okay, that's it from this chapter. I know it was a little bit heavy, a little more technical, but to keep it simple, what you do is make a list how we can mitigate currency risk. 5 options is fine, mix of intellectual, and make a list of interest rate, currency and interest both, 5 option each, and how we can mitigate, and add it to your notes. That's enough from this. Okay. Any questions? So in tomorrow's session, hopefully we'll complete the F3. I hope you guys are watching the recording before you come to the session, or at least you are reading it. Ideally both. Okay. So read this last section. This is very important. It's about business valuation and post-merger and acquisition issues. This is asked in every exam. I've seen this more than 90% of the exam. I would say every exam, but at least 90% I will say. So last 3 chapters. Why we do merger acquisition, and merger acquisition, the most important part is how we value the business and what are the problems we have after the M&A merger and acquisition. It was asked in November and it should be a part of February exam also. Okay.